Today is October the 12th, 2021. Here's Andrew from the optioncrusaders.com. I want to share my thoughts on FOMC interest rate hike in 2018. You can always read the blog on optioncrusader.com. This is one of the first videos we made. More to come. Please forgive us for all the imperfections for now. So what I want to talk about today, this graph here, it shows you 2018, the uprun of the stock market. We had a small 5% retracement between February and May, then we went up again. The same happened the years before. So with an improving economy, we will see inflation will increase as well. I will show this later, but here we can see how the stock market is increasing. Due to the increased inflation, the FOMC hiked interest rate by 25 basis points 4 times in 2018. So in the last meeting in December, Jerome Powell, the same guy in charge today, announced that he will only increase 2 more times in 2019 and not 3 times as he had planned before. And with this announcement, the stock market just went south. How much? It was up 294 points and then it dropped down to 233, which is a 20% drop. That's the official declaration of a recession imposed by Jerome Powell's tapering policies, interest rate hikes. So you revise this and the stock market starts climbing up again in January 2019, and in May we were at the same point we've been in October. So in October 2018 has already started out because the rumors were already around, the interest rates were already hiked up, so they had a little level of support and resistance level up here, but then in the latest meeting they just made the announcement and bang, it went all the way down. Now, why did he hike interest rates? You can see here on data derived from the manufacturing index. As you can see here in the red line, the production is pretty much climbing all the way from 2015 to 2018, and then it becomes stagnant, and this is the effect of inflation. The black line is the purchasing managers, how much they pay for whatever they order, and the prices are going up. So in 2018, already starting from here, actually, Jerome starts hiking interest rates, 25 basis points at a time, 4 times in 2018. So it slows down the economy. It slammed down the inflation big time too. So that's actually a pretty healthy thing when we can see that the production is going up. The green line here is the employment. We see that the employment is following pretty suit. The economy stagnates and then reverses. The employment numbers go with it, and usually the prices come down as well. In the economical downturn, we have a deflationary environment, while this was an inflationary environment, especially when you see these bubbles here. That's when they start tapering, should start tapering. So now this one here is Mr. COVID, the Chinese virus coming in, and we see right after, in April, May, that the production were going up and then stagflates. But what we also can see is that we have employment creating a gap and lagging behind. That's why the production cannot continue to rise, and also because of the bottlenecks in the supply chain. So, but this gap here is interesting, and what is also interesting is that the inflation usually walks with production and creates a bubble. So this bubble is now much bigger than in 2018, right? But we see stagnant economy, but they already started tapering over here. Here we have a stagnant economy, and there is no tapering happening, but we see an inflation. This is a typical sign of a stagnant inflationary economy. We call it stagflation. Now, what does it mean? Here, the government, under Trump, they paid the people because they could not get to work. They had to stay home. They received money. Today, people don't get paid because they cannot go to work. They get paid to stay home because there's no need for this incentive. With over 10 million open jobs, there's 1.5 jobs for every unemployed person in the United States right now. And that drives the wages up, leads to wage inflation, which also is part of the cost input for the production, which ends up in the consumer price index, price of the goods and services. It will end up there, no question. And here's the graph I was talking about, the University of Michigan Consumer Sentiment Index. The economic conditions is in the red line, blue line is the expectations for the consumers, and the green line is the sentiment index. This is when the Trump administration pumped in a lots of money. They pumped in less and less and less, but we're still pumping money because you have to continue this line here. This is just a big check they wrote. And it had the reason because the people could not go to work, right? So the outlook for the economy slumped and the expectations as well. Then when the economy improved, the red line here, we had a change in the administration. The Biden administration pumped in lots of money too. I'm not sure if this is more or less as the Trump administration did, because they have two spikes, but they are thinner. But the question is if it's still necessary. So now we get all the concerns about bottleneck, inflation, commodity prices are rising, and we see all other prices rising too, because the consumer has to pay much more now in the grocery stores than before. So all your wages went up 5.6%, but the inflation is eating this all away, more than that. So you end up with less money in your pocket. If you look at the current economic conditions, they are all the way slamming down to almost COVID levels, okay? And consumer sentiment index, they are all even here below the levels of the pandemic. You see the green line here, just move it over. So the outlook is worse than it was when the pandemic started. That's all what I want to say. So the danger compared to 2018, when they already started tapering, even the economy was going up, because remember the black line of the inflation or prices, and then they slumped down. We have the same picture today with the going up 2019, the COVID going up and upper. There's no retracement. All this 3% here, 5% here, we don't have it since a year and a half. So the slump into the abyss will be big. I can imagine a 40% drop, and it will delete all your investments. If you take a look at the IWM, small cap of the Russell 2000, let's take a quick look to the IWM, what I was going to say. The IWM, the small caps of the Russell 2000, had a nice uprun all the way to February. In February, late January and February, the whole sentiment of the stock market changed. You can see it pretty clearly here in the IWM that the whole thing was just moving sideways since. So it's 9 months further down the road. You see every blue line here is 1 month. You did not make any money. Whatever you had in the end of January is the same amount you have right now. So that's a perfect trading setup for my purpose, because you could have made thousands of dollars in this one. And I will show you in another video how that works. So, but what I want to point out is that the uptrend is moving in the side movement, and since the expectations are here for a downturn in the stock market, the price for the IWM will also go to the downsides. Coming back to this picture, I can see we might have a 20 to 40% drop down. What I see in fiscal policies and monetary policies, I cannot even bring this all into this video, it's just too much. But what I see, this drop can go all the way, I don't know, 40%, 50% drop, and then it will take over a year to get out. We will not get out by next year midterm elections. The stock market will crash before that, and we'll have a long way to recover. So be prepared for this.